Welcome to Next in Tech, an S&P Global Market Intelligence podcast where the world of emerging tech lives. I'm your host, Eric Hanselman, Chief Analyst for Technology, Media, and Telecom at S&P Global Market Intelligence. And today, we're going to be discussing cyber insurance, an interesting angle that brings together some of the financial perspectives, some of the technology perspectives, a range of different aspects that all come together in this interesting conjunction. And to discuss it with me today, I've got three of the analyst team with me: Dan Kennedy, Tom Mason, and Scott Crawford. Welcome back to Dan and Scott. And Tom, welcome to the podcast.
Thanks for having me back.
Good to be here. Thank you.
Thanks, Eric.
Well, it's great to have you all here. And this is an area we've really done some interesting collaboration, because if we think about some of the pieces that we typically cover in security, the fundamental aspect of security is all about managing risk. And I think we often focus on the technology piece of this. But in point of fact, if you're thinking about mitigating risk, of course, one critical component of risk mitigation is to be able to transfer risk with things like insurance. Now, this has been a really lively market. There's been a lot that's been going on, and the technology pieces have also had such a big impact on this, in that the technology that the attacker communities are using have evolved pretty dramatically. And so we've got both a technology race and also a situation where the insurance markets are trying to make sense of what this looks like, which has led to all sorts of back and forth changes in rates and a lot of different things. But Tom, I wanted to start maybe from the insurance side perspective. You cover insurance for Standard & Poor's GMI. And really, you've seen some pretty telling numbers in terms of loss ratios and premium increases, and really from the insurance side. Can you give us some background into what you've seen in the recent past?
Yeah, so since the start of the pandemic, cyber insurance has just been an exceptional source of premium growth. So in the insurance world, we generally look at premiums as the size of the market, and premiums written grew 21% in 2020 as the pandemic kicked off, 61% in 2021, and 48% in 2022. And that data comes from the NAIC, which is the insurance industry regulator. And to put that in context, the entire property casualty industry, so that includes auto, home, businesses, airplanes, what have you, only grew 2% in 2020, 10% in 2021, and another 10% in 2022. So as you can see, cyber just exploded, particularly, due to the pandemic. But there are a few caveats to those numbers. I would say one is that cyber is a relatively small line of business. So if you look at cyber in relation to that entire industry, it's only about 1% of premiums written. The other is that premiums are the dollar amount of the policies sold. So if you look at the number of policies that are written by U.S. insurers, what we call policies in force, there's definitely an uptick in demand in 2020 as ransomware attacks really started to pick up, and policies in force rose 21% that year. But they're actually down 7% in 2021 and up only 4% in 2022. So what does that mean? The premium increases for the past few years have been largely driven by higher prices, which is what we call those rate increases in the insurance world. And if you look at data from insurance brokerage Marsh, which is one of the giants in the industry, they said that prices more than doubled on average in 2021. But we have started to see that come down in 2023. Insurance markets are cyclical, and as more competitors come into the space and write more business, we're starting to see rates. Marsh said that pricing declined 4% in the second quarter of 2023, 6% in the third quarter.
Wow. But nonetheless, those are some really wild swings in a business that doesn't typically see those kinds of gyrations.
Yeah, definitely. I could see why insurance companies were quick to want to get into that market, but it is a really tricky one. Relative to other lines, it's pretty hard to write because there's just not as much data on the losses. So I think the easiest thing to do is let's just price that in, make sure that we cover ourselves in the event of a huge loss.
Well, it sounds like, and I guess we'll dive into some of the tech specifics around this, but this, of course, is one of those things that we think about what this back and forth really looks like. That's an area that we see from the technology side as well, and some concerns with rates having those kinds of swings. I mean, there's a lot that's going on there. And Dan, for some of the 451 Research's Voice of the Enterprise survey data, you've been looking at expectations around cyber insurance and really what security professionals are looking at that. What are you seeing in that end user data about what's actually taking place?
Yeah, it's interesting. On LinkedIn a while back, I saw a CISO kind of humble bragging that he managed to keep rates in the same place year over year in a cyber insurance policy. And I thought, my goodness, is this emerging as a security leadership skill set? Keeping premiums at a minimum. And it is interesting to look at how is it actually affecting programs in place? Is it raising a baseline? Is it leading the programs? Is it causing a case where they're starting to pick winners and losers in the cybersecurity product categories? And something like 77% say that their cybersecurity policies require specific tools. And you see it in questionnaires. Do you have a SIM? Do you have phishing protection? So on and so forth. It's interesting to see. And does it affect procurement? 15% say yes. If a security product will affect our insurance premiums, better to say things already happening. 15%, 40% saying yes, definitely, it has an effect. 37% saying it somewhat has an effect. So now you're looking at a situation where, one security vendor over another, let's say EDR, they can make a compelling case around minimizing insurance premium raises that Tom was talking about. That puts their product ahead of another one. So it's a little unclear if that's the right way things should be happening. But at the same time, a number of these companies, these end user enterprises, and Tom mentioned the face of ransomware, are asking, what should we have in place? And a lot of insurance companies are involved with the cleanup after an attack. So it's kind of a natural extension that technology recommendations were going to be on the way.
Wow. So we are getting into very different territory than we would have been even just a few years ago in terms of what that expectation is. Well, and I guess, we're in different territory in the extent to which insurance is being leveraged as a means of transferring risk. There's so many different dynamics that start to come into this. If we think about what that starts to drive and how those potential impacts start to really be felt, I guess it's that question of around the impact of the tooling that you've got, where that happens to come in and the integration around that. And I guess a lot of this is now not necessarily proving the efficacy of the tools necessarily to your environments, but now it's actually managing that with the insurers that you're working with. Scott, you've been writing a lot of research around this and looking into some of how this starts to manage this, but how do you see this as really shaping the extension of technology into these intersections?
Well, yeah, you've put a finger on, Tom and Dan both put a finger on a couple of things that have really driven this market. And one of the things that's just unmistakable is the rise of ransomware, and the impact of ransomware is probably the most visible example of what's changed the landscape with respect to risk resilience, risk posture in terms of cyber risk posture for organizations, and how organizations measure their exposure through the impact of actual incidents. And from the insurer's point of view, their exposure to their insureds as far as their posture, what they've done to protect their environment, and so on. So this has given rise to an intersection of, on the one hand, the interests of the insured, the organization seeking cyber insurance, who has to build a resilient risk posture, and the insurer who is accepting that risk transfer. And what kind of fences do either of them put around as far as the assessment of exposure, limits on risk, when it's appropriate to transfer, as Dan alluded, actually measuring those kind of things on behalf of the enterprise. And for the insurer, having visibility into the insured's posture in enough detail to competently say, yes, this looks like an acceptable risk. So all of these things have come together. to drive greater visibility into the risk posture of an organization for the insured's sake, as well as for the sake of that organization qualifying and being able to afford cyber insurance. And for the insurer, the visibility in detail into that risk posture, not only at the time of qualifying for coverage, but over time, so the insurer can maintain that visibility into the adequacy of the posture for the sake of continued coverage. So we've seen these drive a number of technology trends. And one of them is the intersection of these interests in a field that is generally and broadly referred to as cyber insurtech. There's some variations around how it's referred to. But that's the general umbrella that we've seen, this convergence between cyber technology and the interests of cyber insurance. And it covers some key areas. And among those are, that sort of visibility into an organization's risk posture. How do you get that detail? Historically, that's been handled largely through questionnaires. But the ability to gain that telemetry through automated reports, automated assessment that's readily obtained and able to be handed over effectively to the insurer, that's a rising area of this sort of convergence of cyber insurance and technology. And another is the ability to partner with the technology providers that provide that telemetry on the one hand, and on the other hand, partner with insurance providers, and in some case, for these providers of cyber insurtech to become carriers themselves. In fact, Tom, you've seen a number of these companies that have made acquisitions of carriers in their own right over the last couple of years. We've seen companies like some top of mind names probably would include the likes of Coalition, At Bay, Corvus, Cowbell Cyber, Resilience, which is the DBA for Ocrea Risk Services, Box Insurance, and so on. And this field has taken in over $1 billion in venture funding alone when we looked at this last year. So it's a rising area of convergence between the cyber insurers and the technologies that give this telemetry, that are the controls that assure this resilience against these more common and widespread attacks like ransomware, and to give both insurers and enterprises a footing going forward into how do they measure this? And this, again, is a growing area for another set of tools for cyber risk quantification. How does an organization actually measure its exposure? How does it apply the practices of cyber risk assessment and measurement in order not only to measure exposure, but to know where to make the right investments for minimizing exposure? So getting back to what Dan was saying, as far as CISOs becoming, this is something of an area of expertise. I save the company this much in 15 minutes with your cyber insurance technology will save you 15. I don't know how much in premium.
There's an advertisement in there somewhere, but
there is.
Well, but it gets into what I think is one of a couple different challenges. One, you've got to get to a point at which you can prove to your insurer that you are reasonably protected. But I think there's a point that we need to emphasize in the middle of this, which Scott, you'd mentioned, which is that these are risk levels that evolve over time. And that, cyber insurance was something that people were writing, years back, but that a change in the attack profiles that are out there and the severity of the attacks shifted from what had been sort of the original malware version of what I like to refer to as sort of the janitorial security approach, which is, malware in aisle 3, get somebody out there with a mop and a bucket. Let's clean it up. We'll reimage a few systems and we'll get it fixed. To this shift to what more effective ransomware attacks are doing, which is really creating an existential business risk that a successful attack can put you out of business. And that has so dramatically changed this. And I'll make the case will continue to change as the nature of attacks continue to evolve, and that's something the insurance industry is really having a hard time reacting to because, if you take a look at most insurance, the insurance environments, you're working on actuarial tables that are expecting probabilities of risk, percentage loss, those kinds of things. I mean, Tom, you've seen this swing really dramatically in terms of what insurers are actually how they're managing this and what they've had to do to account for this, right?
Yeah. Loss ratios are all over the place, depending on the insurer that you look at. It's just a really hard business to predict. Like I was saying, you might have, so typically in the insurance industry, we talk about frequency and severity. And both of those can just be unpredictable in cyber. So as much as hurricanes damage things, they are very predictable. We know they happen at this time of the year, and they tend to happen every year. You can actually plan for how much you think you're going to lose each year. But with cyber, it's just, it could be a gigantic attack or it could be a small one. A lot of companies have stopped paying ransoms now. So it's, as you said, the market just evolves really quickly and it's really hard to plan for.
Tom raised a great point there. And that's one of the interesting pieces of data that of the folks who have had incidents, 54% were sort of covered for the incident in terms of its total cost or their estimation of its total cost, which unfortunately means then 46% of folks who had incidents were partially covered or not covered. That's something that enterprise security folks need to be highly aware of. The expectation to be able to transfer the risk may not be there, depending on the way the policy is written, what's covered. You don't want a nasty surprise when your ransomware payment is not, in fact, covered.
Well, we went through some of these initial challenges with things like NotPetya, in which you had insurers initially identifying that this was an act of war, that in fact, this was a breakout of an attack tool that was targeted at Ukrainian infrastructure or Ukrainian economic interests. And you're basically then pulling back and you get into this question of, is cyber insurance now an effective means to transfer risk? And if, Dan, to your point, there's an expectation that you're really not going to get significant coverage, then that starts to really shift the extent to which an organization can rely on it.
Yeah, they attempted to define it as an act of war. And we've seen evidence in the industry that insurers will attempt to have you prove that it's not a country level attack. So it doesn't fit in that category. And most enterprises are not equipped to do that level of attribution. So it gets into some very strange places. And yeah, we're a long way from WannaCry and NotPetya. The entire ransomware space has moved from smash and grab or opportunistic to pretty targeted monetized intrusions with some eye-popping ransomware payments. You think back a couple of years to Colonial and CNA Financial, JBS Holdings. Those are some very large payments that were involved in those attacks.
It's been one of those kind of fields that there's been some precedent setting, and case law has helped define the nature of cyber risk exposure and insurance along the way as well, too. One of the things with respect to the exposure to things like ransomware, one of the brokers mentioned to me that, we don't have the ability to predict the future, but looking backward, we do a pretty good job of ruling out the stupid when it comes to some consistent exposures. And that's a lot of what's been exploited in terms of ransomware. That's one of the things that they're pretty consistently focused on. Are there things that can be done to improve cyber hygiene that we talk about a lot? But organizations have ongoing struggles with things like, you hear a lot, well, just patch. That is a lot. That is way oversimplified in the case of a lot of organizations. But still, there's a middle ground to which the insurers would like organizations to move towards with greater consistency with things like that. And organizations are getting to the point where they can begin to competently embrace some techniques for measuring their risk and exposure in those kind of ways and exposure to active real world attacks. But when it comes to coverage aspect that you mentioned and exposure to things like cyber warfare, and is this actually an act of war? There have been some court cases already that have actually ruled against the insurers, saying that you can't really claim that. And in response, some of the insurers have started to curtail their coverage with respect to acts of war. You mentioned the situation in Ukraine. Lloyd's made a move in that direction. They clarified their position on what constitutes an act of war in the cyber realm early in 2023. So, the insurance industry is responding to these events. Courts are responding to the insurance industry's response to these events in a lot of cases. It's an evolving landscape and will continue to be going forward.
Well, it's something where I guess, I know I personally, my initial reaction is, wow, the idea that insurance perspectives are now going to drive security investments is, I have this momentary, like, whoa, we're in a very different world. But in reality, that's actually the way that a lot of the world outside of security works, that insurance concerns drive building codes, They drive a whole range of different aspects of how industries operate. And I guess I wonder, is this an indication of the maturing of the market? And is this just inevitable, or are we going through a phase of adjustment?
Depends on the direction it takes. Now, I always go back to as an application security analyst, I always go back to PCI's original, somewhat clumsy implementation of the application security standard, where it essentially said, you can have a WAF, or you can implement a comprehensive code validation and testing program. So unsurprisingly, a number of folks went with the WAF option, and it drove an industry of network device WAFs that had a mixed level of success. So to me, is the pseudo-regulatory control creating a more effective baseline, or is it attempting to lead the market? And the first one's probably appropriate, and the second one probably isn't. You don't necessarily want an innovative space. You don't want to create winners and losers in an innovative space based on sort of what's happened already. So Scott said it, hygiene is effective. Creating a better baseline is effective. But when you start to recommend specific vendors or very specific product categories, you can sort of get into trouble a little bit.
Well, and for those of our listeners who aren't familiar with it, to clarify, PCI is the payment card industry, and the PCI DSS standards came out, I don't know, when was the first version? Was at least a decade or so ago, maybe? But the idea was that the payment card industry was driving security standards because the concerns were that there were significant losses of payment cards. Basically, credit card numbers were getting exposed, and they set a bar for the kinds of security capabilities that you had to have in place and a process whereby you got audited. And if you didn't pass your PCI DSS audit, you weren't able to handle credit cards. Or there were various strictures on what you could do in terms of handling credit card information. And that really was transformational, but it's, that here you had to your point, a semi-regulatory environment that is looking to go drive these capabilities. And this shift, and I guess, I don't know, I look back at the origin of Underwriters Labs. Most of us sort of look at UL sticker on, all sorts of odds and ends of things and saying, is it seal of approval on whatever it happens to be. But the thing I've always found fascinating is that Underwriters Labs originally was founded to rate the resistance of safes to attack. And there were various Underwriters Labs ratings for the safe that you'd have in your bank or your business as to how long it would withstand various types of attack. And, if it was a brute force attack with tools, crowbars, and hammers, a skilled attacker with torches or dynamite, all sorts of these classifications, what you used to do there. It seems like we're kind of getting into that same environment with overall security standards, in that our insurers are looking to start to evaluate the efficacy of various products and how long they will resist various types of attacks. Are we headed in that direction?
Good luck with that. I mean, we know ourselves. We don't exactly track, but we do see over 3,000 vendors in various aspects of cybersecurity, more or less, depending on whose number you're looking at there. But it's a really complex environment. So when someone like the broker who says that we rule out the stupid says that, we have eyes on things that are pretty consistent, that's really what they're looking for at this point. What are the consistent exposures that can be mitigated with some reasonable level of effort to reduce overall exposure for all concerned, for enterprises and insurance as well? But the level of detail they have to get into for that visibility, that posture, that's the tricky part, because of that growing complexity of the cyber technology environment and the need to have that telemetry consistently available without so much overhead and human effort that it becomes basically just an untenable and much too general summary of, we have this, we have that, so we're fairly well mitigated against this type of exposure. So that aspect of cyber insurance and technology convergence is still progressing. But it's a very complex space. And to kind of illustrate that, I mentioned earlier that a lot of people say, well, just patch. And one of the, even if you had a very good sophisticated patching system in place, We saw with the SolarWinds breach that those trusted systems can themselves be exploited to deliver malicious content in the form of what appears to be legitimate software updates. So, it's a simplistic answers generally aren't going to carry the day, and the adversary knows that. They have the ability to focus on the opportunities that will yield the greatest reward for them with minimal risk exposure on their part. And they'll target the exposures that are the most fruitful for them. And with ransomware, we had seen that pretty consistently for some years.
Well, I was going to say, it's interesting. I'm just looking at an insurance questionnaire before the call. And one of the questions is, applicant has a SIM. This is close to Scott's world. And it correlates the output of multiple security tools. And if you think through that question, it's like, all right, what does that actually tell me? Yes, you have a SIM. Okay. How many systems in the enterprise are sending data? Is the SIM ingesting data from 50% of systems, 80% of systems? Is someone looking at the results of the SIM? Is it monitored 24/7? So do I have something in place that's not a SIM, like an XDR, but it acts like a SIM, but it's not called a SIM? And so for someone even filling out the questionnaire, which is still the most common instrument for insurance procurement, and as Scott mentioned before, and 39% are now using telemetry as well. So that's significant and continuing to become more significant. But even a simple question sets you off in about 5 different directions in terms of, okay, what's the real efficacy here?
And so are we heading towards an audit? Are we heading towards, and I wonder, we're living in a day and an age in which car insurance, you can get discounts if you've got an onboard data port telemetry device. Are we getting towards a situation in which my insurer, from a cyber insurance perspective, is going to want some kind of real-time telemetry about what my security posture looks like?
Real-time, I don't know how sophisticated that sort of telemetry and visibility would necessarily have to be in real time, but something that's reasonably current, I think, is probably enough wiggle room for the industry to have some sense of ability to validate the controls in place. Do they line up with the insurer's expectations? And more importantly, the insurer's recent past experience with losses and claims. But yeah, the parallel that you draw is very apt. That world of telematics, which Tom is familiar with in terms of, that sort of ongoing monitoring of exposure, like from driving habits based on the monitoring of an onboard diagnostic port in the car, for example. We've seen that pretty readily applied already in those fields. And there is a direct parallel. In fact, one of the insurers, AIG, had put forward his program very similarly named Cybermatics for that similar sort of visibility into telemetry in the environment. So that's an objective, but the level of detail and real-time currency has to line up with the claims and the loss data that's meaningful to the insurer. And that is going to be somewhat lagging for the insurer. But as that one broker said, their ability to look backwards and rule out things that are common exposures, that's really kind of what they're looking for. And I expect that to pretty much remain consistent going forward, barring any major incidents that would change that perspective on their part.
Well, Mr. Crawford, you had a whole set of phishing attacks. Your phishing attacks were up, I saw, the middle of last year. So I don't know. We're going to have to do with your rate. So,
Well, I don't think insurers have to be the bad guys. Telematics freaks some people out in auto, but as Scott said, in auto too, some insurers, they'll just monitor you for a period of time, and then they're like, okay, we think we know what kind of driver you are from here on out. But I also like how a lot of startups have kind of taken the good neighbor approach. So when you get into a car accident, you might just want to call your insurance company because you're freaked out. And that's what a lot of these cyber insurtechs have started doing too, particularly in the middle market.
Yeah, that middle market.
Like a good neighbor when ransomware hits.
Exactly. What do I do?
Well, that expertise aspect is not to be overlooked. I mean, it's not just about technology and not just about insurance. It's also about how do you get there? So expertise on the part of the providers, particularly in that involving cyber insurtech space, but also partnership with managed and professional security services providers to offer that guidance and be available to help organizations guide their efforts and offload the functionality for monitoring and telemetry to the extent that it's useful for the organization.
Yeah. Basically being able to do if you're in an accident, call us. We've got the ransomware response capabilities. We know how to manage this. It's interesting. seems to be really sort of wrapping that in very similar models in terms of where that goes.
Yep. Looks very familiar.
Well, fascinating discussions. There are so many other things that I'd love to dig into, but we are unfortunately at time. Thank you, all of you, for all of these perspectives. I will point our listeners to a lot of the research that's going on across this area as well. And clearly, this is something that will be evolving. So a conversation that's certainly going to continue. But thank you all for being here.
Thank you, Eric, for having us.
Yeah, thanks, Eric.
Yeah, thanks again. Glad to be back.
And that is it for this episode of Next in Tech. Thanks to our audience for staying with us. And thanks to our production team, including Carolyn Wright and Caitlin Buckley on the marketing and events teams, and our agency partner, the 199. I hope you'll join us for our next episode, where we're going to be talking about smart cities and the technology that's driving them. I hope you'll join us then, because there is always something next in tech.